I'm Jack Howell from Barron's. If you ask Google a question about geopolitics or the macroeconomy and it doesn't know the answer, it calls Felix Zulauf of Zulauf Asset Management in Switzerland, and I'm lucky enough to have him here with me. Hi, Felix. I want to ask you about the U.S. stock market and what happens after the election. Everybody's got thoughts on who might be better for the economy, who might be better for the market. You were saying it doesn't so much matter who wins this U.S. presidential election, that the fate of the U.S. stock market is sealed. How so?
Well, first of all, the U.S. stock market is right now in a medium-term correction or decline, and I'm looking for a low around election time, probably a little bit after election. If Trump wins, we have rising protectionism, which is bad for the world economy. If Hillary Clinton wins, we will have a gridlock in between the Senate and the House of Representatives, in my view, and there will not be much structural changes that are necessary for the U.S. And therefore, whoever wins, I think the stock market is ready to roll over next year into the next bear market. We are in the last inning of the whole bull cycle that started at the 2009 lows, and the run from a fourth quarter low into the first half of next year will most likely be the last run.
So in your view, early next year is when I pull the ripcord on the stock market or what have you. What happens with, I can wait until then in stocks. What happens with bonds? Yields are rising a little bit. Is this the end of the bond bull market? Do they keep on rising? Is there another low from here? What happens with bonds?
I think we hit important lows in yields in summer of this year in the U.S. bond market and actually around the world. And we have now 1 year of rising bond yields, probably in the middle of next year. So the first step up is almost over. Then some softening, but it will continue to rise. 10-year U.S. Treasuries probably to 2% sometimes in the first half of next year, and that will not help the stock market.
When I'm ready to move out of stocks, I might want to shift more money into bonds to take advantage of, I guess, a flight to safety. But then eventually that ends and the bull market for bonds is over and yields rise?
Markets move in cyclical fashion. Yields go up and down. Stocks go up and down. I think that the stock market peak sometimes first half next year will lead to a lengthy bear market, at least into 18, if not into 2020. Not as severe as 2008 was, in a step-by-step decline. And I do believe that we will have a recession in 2018, and that's why bond yields will come down again during 2018. Whether they will break to new lows below the lows we have seen this summer, that's questionable. I do not know. But at some point, middle of next year, a trader can buy U.S. Treasury long bonds again for for a price gain into 18. Definitely.
And let me just ask you lastly about currency. We were talking earlier and you said the euro currency zone could break up within 5 years. You were talking about the spread of protectionism around the world. Tell me a currency or two that you think will react strongly to that kind of environment, a place where investors might want to make a bet.
The strongest currency will be the U.S. dollar. The U.S. dollar is the main beneficiary of the new environment that we are moving in, with rising protectionism, rising nationalism, and less globalization or deglobalization, and a weak global trade. Because the U.S. is the largest net importer of this world, and global trade on the retreat will mean that your external accounts will improve, whereas the external accounts of the large export nations in Asia and in Europe will deteriorate. And that is going to have a big swing effect on the currency. And that's why I think the US dollar will be bullish well into the first half of next year.
Got it. Thanks for talking it over with us, Felix.
Most welcome. Thank you for having me.
And thanks for watching.